Hello and welcome to another TLC Tutoring Company accounting lesson. We're going to be going over another buyer-seller entry example. Now, like we said in example 1, keep in mind this is the net perpetual method. So you're going to want to check with your instructor or your textbook to make sure that this is the method being used in your course. So we have, again, the buyer, Benson Pharmaceuticals, and the seller, Sager Company. And again, please make sure that you note that we are using the net perpetual method here. So if you would like a more in-depth explanation of how these buyer-seller entries work, please see buyer-seller entries example number 1. That'll be linked in the description below. And also keep in mind as you're working through this, you can go to our website for the blank Excels, or if you want to print out a Word document, that way you can follow along as you go. But if you do want to get a more in-depth example, please make sure you're looking at example 1. We're not going to be doing every single thing piece by piece or explaining every single thing here piece by piece. So if you do want something more in-depth, go to example number 1. So for this first one, we have March 19th. And we have Benson Pharmaceuticals purchasing $12,000 of merchandise from Sager Company with the credit terms 115 net 30. FOB shipping point this time, which means that the buyer is responsible for paying for the shipping. The cost of the merchandise sold was $7,000. So our first entry is going to be to record the sales price. And so since this was a sale on account, due to these credit terms, we're going to be debiting accounts receivable, an asset to make it go up. And the amount that we're debiting it for is going to be $12,000 times 99%, because there's going to be a 1% discount allotted here. And then we will be crediting sales to record that this company had a sale. Now also on 3/19, we're also going to have to record the cost of the merchandise being sold for the seller. So we're going to debit cost of merchandise sold, an expense, to record that it's going up. And then we're going to have to credit merchandise inventory. And keep in mind, the cost of the merchandise being sold is not adjusted for the discount, because this is actually a separate item. The discount only refers to the sale. Now on 3/19 for the buyer is going to debit merchandise inventory, an asset, to make it go up. And they're going to credit accounts payable, a liability, to make it go up as well. So they're recording that they're receiving some merchandise and they owe some money to the seller. Now on March 24th, Benson Company pays $250 for shipping. So the buyer is paying, FOB shipping point, the buyer should be paying. So in this case, the seller actually does not have an entry. It's the buyer that we're going to be focused on for this one. Now, if you remember in example number 1, it was FOB destination, so the seller was paying. In that case, we had debited delivery expense. But when it is FOB shipping point and the buyer is paying, we're actually going to be including the cost of shipping in the cost of that merchandise that's coming to the buyer. So any cost that's related to this purchase is actually going to be debited to merchandise inventory for the buyer. So if the buyer had to pay for sales tax, if the buyer had to pay for shipping, as is in this case, if the buyer had to pay for insurance while it was in transit, all of these costs would be debited to merchandise inventory. And it would simply go into the cost, and eventually when they sell it, it would go ahead and be moved through those goods as well. And cash, because they are simply paying for the shipping. Now it tells us here that on March 29th, the buyer is returning $2,000 of the merchandise that was previously purchased. The cost of the merchandise returned was $1,300. So remember, when we are doing these returns, we're going to be taking out of those bucket accounts, customer refunds payable, and $2,000 times 99% to adjust for that discount. Remember, if you go ahead and if you discount the sale, you also have to discount the return. And then credit accounts receivable there to show that it is net of the discount. And for the cost of the merchandise being returned, we're going to be debiting merchandise inventory for the $1,300 and then crediting that bucket account that we talked about in example number 1, estimated returns inventory. And for the buyer, it's simply going to be a flip of what they did in the original purchase. So $329, we're going to be debiting accounts payable and crediting merchandise inventory. Beautiful. And now on April 2nd, Benson Company pays for the merchandise. So the first thing we want to do is make sure that this purchase is being paid for within the discount period. So if we go up to the original sale to see the credit terms, it's a 1% discount if paid within 15 days. Since this was on March 19th and they are paying on April 2nd, that is within 15 days, so they do get to keep the discount. So the seller is going to be receiving cash, and they're going to have to decrease their accounts receivable to show that the buyer no longer owes them that money. Now, the amount of cash that's being received is equal to the original sale, net of the discount, minus the return, net of the discount. So in this case, they're getting $9,900 cash. And there's actually a second way that we don't talk about, or we haven't talked about yet in example 1. Another thing we could do is we could take the whole of the numbers and then adjust them by the discount. So for example, the original sale was for $12,000. $2,000 of that was returned. So that will net us $10,000. And then adjusting it by the discount, you'll see that that method works as well. So if you are uncomfortable or if you get some testing anxiety, you can go ahead and check your work by going ahead and taking the wholesale of the amount, minusing out the return, and then adjusting by the discount. Both should give you the same result. Now for the buyer, the buyer's accounts payable now is going to be going down because they do not owe this money anymore. And then their cash is going to be decreasing. So the cash is decreasing for the buyer, increasing for the seller. For the seller, accounts receivable is going down. For the buyer, accounts payable is going down. So they are related. All right, hopefully after these examples, you're starting to get a better feel for those buyer-seller entries. Remember, if you haven't done example 1 yet and you want a little bit more practice, go to our website and print out the buyer-seller entry Word document. Or if you'd like, you can go ahead and open up the Excel spreadsheet and follow along on your computer. And just so you can test yourself out and then follow along with the video to see how you did. And as always, please make sure that you leave any questions in the comments below. We'll do our best to answer those as soon as possible. And until next time, thank you so much for watching. Please be sure to subscribe and happy studying.